Yeah. Welcome, Patriots. Welcome back to Military Money Mondays. It is that time again. Military Money Mondays, the weekly live stream where we help our nation's heroes safely build wealth, cut their taxes, protect their families, and create lasting legacies. So I'm your host. I'm Dan Farnsworth. I'm a retired naval officer and the founder of Victory X Financial. I am a licensed financial professional and a military wealth specialist. I founded my agency a few years ago as a way to give back to the veteran community that gave so much to me during my career, and it's been great so far. It's been great staying connected to the community and being able to help so many of our nation's veterans to be able to do the things that we do, right? To be able to build wealth safely, not have to worry about market downturns, not have to worry about taking high risks, on their retirement, basically guaranteeing that financial peace of mind. All right, so what are we talking about this week? Well, we're kind of going outside the lines a little bit, and we're going to talk about term insurance, right? We don't talk much about term insurance on this channel, but this week we're going to talk about term insurance because I don't want it to seem like all that we do is just, sort of in that higher ticket investing type category, right? We also want to talk about cost effectiveness, right? And there are a number of our clients that are just simply looking to, secure a low cost form of life insurance to replace SGLI or just to ensure that, their mortgage is protected, while they're still paying on it, or, that their family's protected while their kids are still young. So we're going to kind of get into that topic. So let's go ahead and go down the screen and we'll get it started for this week. All right, so here we go. So this week we're going to be talking about how veterans can protect their families and save the most amount of money on life insurance. Because there's one major virtue with term insurance, and that is that it's very affordable. More so than most people think, right? When they think life insurance, they start thinking high cost, right? Oh, that's got to be so expensive. No, it's not. And as an independent agent, I'm contracted with numerous, probably at least 35 different carriers. They're all A-rated, nation's top carriers, world's top carriers, and we can shop this kind of coverage around to make sure that we get you the best possible rate. So let's go ahead and dive into what does term insurance typically look like. So again, this is pure affordable protection, right? And we're going to talk about how we can deliver the maximum amount of coverage at the lowest cost for veteran families. The theme of today is all about saving money. It's also about shoring up coverage gaps. Okay, so when you separate from the military, you lose your SGLI coverage. That's the end of that $500,000 of group term that you've been paying into for the entire time you've been in the military. That goes away, obviously, when you separate. So we replace that, oftentimes with a very affordable type of coverage and one that will serve you for a long period of time while you're still paying on the mortgage, while your kids are still young, and while your family is still depending on you for that income. Okay, we can specialize this or we can customize it to what we call a mortgage protection plan or mortgage protection insurance. And these are basically solutions that are designed to cover your mortgage or even a portion of it if something were to happen to you. We'll also kind of talk about what happens if you outlive the term, right? And we want to compare all the options. We can look at, options like VGLI and the Survivor Benefit Plan, SBP. But really we want to focus on how can we save the most amount of money and get the most amount of coverage from this form of insurance. All right. So if you're joining the conversation, go ahead and drop a comment below. Love to hear where you're from, where you're tuning in from. And if you guys have any questions, go ahead and drop those in the comments. I promise I will answer every single one of them. So go ahead and drop your questions in the comments below. If you're watching this on YouTube, same thing. Just put those questions in the comments, and I promise I will reach out. All right, so the problem we're solving today is, could your family keep your home if your income stopped? Now, I know this is not a popular topic, right? I understand that most people, especially young people, don't like to talk about death, right? We don't even like to think about death. It's so far down the road as far as we're concerned that, we just figure, well, if it happens, it happens, and that's just the end of it. Well, yes, I mean we all want to assume that we're going to live a long, prosperous life, but we just don't know, right? I mean, life things happen, right? Catastrophes happen, accidents happen, weird things happen. Certainly, chronic illness and disabilities happen, right? Things with our health deteriorate over time. So we want to be asking ourselves, because as veterans, we're trained to expect the worst, right? We're trained to deal with the worst case scenarios, right? And to be prepared for that. So we want to prepare for the worst case scenario. The worst case scenario is, what if you died tomorrow, right? What if God forbid something were to happen, something terrible, and all of a sudden your family was left to have to cover the cost of the mortgage, right, for your house or the rent or whatever else, debts, existing bills, all that stuff, right? How would they pay for that? Because you guys realize that, I'm sure you do. If you don't, I'm going to tell you, the mortgage company is not going to give you a reprieve just simply because your income stopped. Okay, the credit agencies, the loan companies, the banks, everybody, where the billing companies, nobody is going to stop charging you or your family just because you're no longer around to pay the bills. Okay, those bills are still coming due. And when we look at, even survivor benefit programs like SBP, a lot of times, even if we have those benefits, it takes months for them to get turned on. Okay, literally months. And in the meantime, the mortgage bills are still coming, and life is not getting any easier for your family, right? So this is something that we need to be serious about, right? It's a very serious topic. We want to make sure that our family is protected if, God forbid, something were to happen tomorrow, right? How would they be able to cover these expenses? And that's assuming that, we're now out of the military. We no longer have SGLI, or, as we'll see in some of the example scenarios here tonight, even if we're still in the military. Okay, you think about $500,000 being a lot of money, but when you start adding up your expenses, when you really think about it, right? How much is your mortgage, right? How much are your car payments? How much is your, college tuition payments, your credit card bills, your electric, your, gas, groceries, all that stuff, right? When you add that all up, $500,000 may not be enough to cover all of it. I have witnessed cases personally, right? Long before I was even in the insurance company or insurance agent or industry, I've witnessed cases where people have, unfortunately, widows have inherited $500,000, and that money was literally gone within a few years. Literally gone, okay? Because they weren't managing it well. Okay, so again, we want to make sure that that the amount of coverage that we have is going to cover our expenses, so that our family is going to be in much better shape, if, God forbid, the worst were to happen. All right, we'll talk about employer plans a little bit. Most of them fall short. We hear veterans and other clients say, "Oh, well, I have insurance through my work." Well, when was the last time you reviewed how much coverage you have through your work? Because in most cases, most group term plans that employers offer are nowhere near even the SGLI coverage. So you want to make sure you're aware of that. All right. So this is what we call Term Life 101. Okay, what is term insurance? Well, term insurance is what we call pure protection or pure insurance, right? Which basically means that we're getting the maximum amount of death benefit for the lowest per dollar cost, okay? There's no cash value component with this. There's no investment features, right? We're not growing tax-free wealth with term products, right? What we're doing is we're just strictly securing a death benefit coverage, but we're doing that for a very low cost, okay? That coverage is gonna be guaranteed to pay a tax-free lump sum at the end of your life. Now that doesn't necessarily, or at least if you don't survive the term. Okay. It's not going to be permanent coverage. It is going to expire at some point, but we can talk about what we can do, the conversion options and so on and so forth. The other thing that you're guaranteed with term insurance is you're guaranteed a level premium, meaning that your premium's not going to increase, from the time you start to the time you finish. Okay. Your coverage is going to stay locked in from day one. So let's say you had a $500,000 policy, and it cost you $48 a month, right? That $48 a month is going to last the entire time that you have that policy, right? If it's 30 years, if it's 35 years, whatever, that premium is going to be the same every single month for the entire term, okay? So you basically have sort of a rented protection policy for the years that you need it the most, right? I understand that some clients, they don't plan to leave a massive legacy benefit at the end of their natural life, right? They just want the coverage while their family depends on their income the most, right? When they're paying down their houses, when they're when their kids are young and they require that income to be able to sustain their quality of life. They just want to have that protection in place. And this is a great way that we can secure that. Okay. Now where it really shines is in what we call the mortgage protection space. Okay. So when every dollar counts and you need maximum coverage, this is where term insurance really delivers the most for the least amount of money. So it's perfect for kind of those growing families. Okay. It's great for protecting your mortgage. Okay. And there's certain ways that we can do that. Three strategies in particular, but it kind of branches out from there. And certainly replacing your SGLI when you get out of the military, okay? Because most people, when they get out of the military, they're still fairly young. They're very inexpensive to insure. So this is a great way for us to very simply, very easily, replace SGLI with minimal application process, with in most cases, no medical exams. It's a very simple way for us to do that. And to not use VGLI, by the way, because again, we're talking about a level premium. It's not going to increase every 5 years like VGLI. Okay, so the three basic strategic approaches to mortgage protection. So the first is what we call the payoff plan. Okay, and what this is going to basically do is it's going to pay off the full remaining balance of your mortgage if something were to happen to you today. So think about kind of how much is left on your mortgage. Okay, so maybe you've got $300,000 remaining on the mortgage to pay the house off, right? This plan would basically give you that $300,000 of coverage, and it would pay off the mortgage if something were to happen. And of course, as you're kind of going along, and you're still continuing to pay down the mortgage, let's say you live, you outlive the policy or whatever, then if something were to happen to you, later on, let's say towards, let's say out of a 20-year policy, God forbid something were to happen to you at the 15-year mark. If that were to happen, you basically would now have still $300,000, wouldn't have to necessarily go down over time, even though your mortgage is going lower, but it would still pay off the remaining balance. So just think of this in terms of like we tailor the coverage to pay off the mortgage. We can even adjust it, over the years if we want to, reduce the premium as your mortgage comes down. Okay, then we have what's called the value plan. Okay, the value plan basically is if you were to sell your home for full value today, how much would you get for it? Okay, if your home is worth, let's say, $450,000, right, and maybe you've got, $300 left to pay on the mortgage, this would cover the entire $450,000 as if you were to sell it today. So basically your family would get an immediate $450,000, right? It would avoid probate. It's tax-free. It doesn't affect their income at all. They can basically roll that money into a new house as if they were selling their home, but they don't have to worry about going through, all of the effort to get the house, ready to sell while they're trying to grieve. They've got time to be able to do all that. They're able to pay off the mortgage. If they do want to stay in the house, awesome. That just alleviated all that pain, all that stress of having to move, having to relocate. I mean, imagine having to do that at the worst time of your life, when your loved one just passed away, and now you're having to worry about losing your home and finding somewhere else to live and doing it all, in a very short period of time under a great deal of stress. I mean, that's not a formula for success, right? That's a formula for failure, and that's just going to make it worse for everybody. So this would basically be the equivalent of selling your home for the full value. They would be able to secure that from day one, and then they could still sell the home if they wanted to, right? So it could end up doubling the value of the house, essentially, because they would still have the total house paid off. They could still sell it later on if they wanted. Okay, and then we also have a payment plan. Now, the payment plan is going to be more for, if we're looking at it more from a budget-minded perspective. Okay, we're trying to save the most amount of money. So rather than thinking about, okay, well, I need $300,000 to pay off the remaining balance, I need $450 to cover the full value. What this might be able to do is at least cover maybe a year or 2 years worth of mortgage payments. Okay, so whatever your mortgage payment is, we would just calculate that out, and it would cover those mortgage payments so that at least your family would have time to, one, grieve. Obviously, that's the most important thing. They would have time to grieve, but then they would also have time to prepare the house so that they're not just doing this, willy-nilly, at having to drop everything, and Lord knows, what issues still need to be fixed and what needs to be, rehabilitated in the home. We want to try and spare all that and give time for all this to happen on a comfortable timeline. So we could do it for maybe a year or two, and that's going to be an even more affordable solution than if we just simply paid off the entire remaining balance, or if we did the value plan to pay off the entire house. Okay, so each approach serves a different goal, different budget, and the right choice really just depends on your family's needs, right? What would bring them the most security and the peace of mind during an already extremely difficult time. All right, so let's look at some real world examples here. So obviously these actual rates are going to vary based on your age, based on health profile. Okay, that's a huge part of what we do in life insurance. Also things like tobacco use, state regulations, etc. But if we just kind of look at some ballpark numbers, okay, so a healthy 40-year-old veteran, right, a healthy male 40-year-old veteran, females are going to be a lot less, but a male can secure a $500,000 30-year policy. Okay, so this is a policy that's going to be in effect for 30 years, right? It is potentially renewable after that, but for 30 years is going to be under $50 a month. Okay, the main thing that I want to stress here is that we're securing this coverage while he's still young and healthy. Okay, because if he waits, right, let's say he waits till age 45, 46, and then God forbid something changes dramatically in his health, the cost of that coverage could go up significantly. In fact, it could become almost unaffordable. So we want to secure that coverage as early as possible, even if, it'd be even better if he could secure it before he's 40 years old. But if he's starting at 40, the best time to secure it is right now, okay? While he's still healthy, while he's still young, and he can secure that coverage, and then that premium is locked in for the next 30 years. It's never going to increase. Okay, if he wants to convert the coverage later, that might affect, the premium later on, but that's only if he wants to do that. The cost of the coverage is guaranteed to be locked in for at least 30 years. So while he's paying the mortgage down, while he's, supporting the family while they're young, while they depend on him for that income, he's going to have that $500,000 of coverage if, God forbid, something were to happen to him. All right. So really, at the end of the day, we got to ask ourselves, what's the primary goal? So you guys are attending here in the chat. Go ahead and type in the comments section, right? A, B, or C, right? What would be the goal that you would be after if you were going to protect your mortgage, and use this type of insurance as mortgage protection? What would you want to do? Would you want to pay off the mortgage completely? Would you just want to cover maybe a year or two? Or would you want to replace your income for at least 10 to 20 years and possibly pay off the entire value of the home? Okay, so go ahead and type that in the chat there, A, B, or C, or just a 1, 2, or 3. Let me know what you think, and we'll keep moving here. All right, so let's talk about the SGLI gap, right? What happens after you leave the service? Well, you guys know if once you leave the service, whether it's any of the various branches, including the reserves and the guard components, your 500,000 of SGLI, that's a group term policy in the military, that coverage ends, right? The minute you're out. So you've been paying in this whole time. It's about 30 some odd dollars a month, for SGLI. It's extremely low because it's 100% participation rate. So everybody in the military has to have SGLI. They have to. That's how they keep the cost down, right? But when you separate, that coverage goes away. It's immediately gone, right? Terminates immediately. Now you have the VGLI option, right? Veterans Group Life Insurance. It does exist. But here's the thing to remember with VGLI. We've done other videos on this. We will continue to do videos on this. The premiums increase every 5 years, and you can look up what the rates are. They're standard across the board, right? You can look up what those look like in every 5-year age period, what those rates are. But just know they increase every 5 years. They might look kind of attractive when you're young, but believe me, they get really, really expensive as you get older. I mean, a 65, 70-year-old is going to be paying over $1,000 a month. Okay, so just keep that in mind. Now, civilian employment a lot of times will come with added benefits, which include life insurance coverage. It's an incentive that employers offer for recruitment and retention, but oftentimes it's kind of low. Okay, it's certainly not going to be anywhere near the SGLI coverage unless you have some kind of a special plan. If you're in sort of an executive level management position, most employees only get somewhere between 50 and 100,000, if that. And many really don't have anything at all, when it comes to employer provided coverage. So this gap is where veterans really become vulnerable, right? Because they get out and they realize that their families are no longer protected. And, oh my goodness, what am I going to do if something were, God forbid, to happen to me tomorrow? Okay. And this kind of dovetails into my story. Okay. So when I first retired from the Navy, for a short period of time while I was building my business, I did some contracting work. Okay. And one of the things that they went over with my company, I won't say names, but one of the things they went over was the life insurance that they provided. It was, I think it was right around 100,000 that they offered in group term insurance, which sounds good, except for the fact that my mortgage was higher than that. Okay, and at the time, my wife was going to school, so we were kind of living off of just a single income, right? So I'm kind of supporting the family, and if something were to have happened to me, I mean, there's no way that 100,000 would have covered everything. It would have barely got us through a year, and so so I needed to make sure that I had enough coverage during that time that my family would be in a good spot. Obviously, it's going to be a terrible time, but that they would at least be protected if, God forbid, something were to happen during that time. Okay, so just give you a personal anecdote there, right? Most of the time, employers, they don't really even emphasize the coverage very much. I mean, if you talk to like the HR folks, they'll tell you about it, but most employers don't even really emphasize life insurance coverage. So if you're wondering whether or not you even have coverage with your employer, I would definitely get into the your hiring paperwork and find out. It might be listed on your pay stub or your LES equivalent, whatever that might be. But I would definitely want to find out what that is, because chances are if you have group term, you're probably paying into it, and it probably isn't enough to cover your expenses. So, all right. So how long should my term be? Well, we like to try and pair this up and match it to your biggest risks. So when we look at this as a benchmark, we use a mortgage because the mortgage is typically the largest expense for most people, right? Most Americans. There are calculators out there that we can look at, 15, 20, 30 times your income, and, subtract all the debts or, whatever, do all this math stuff, right? But really, just as a basic benchmark, we like to start with the mortgage, right? That's the biggest expense that we have in most cases. So when we look at how long the, is remaining on the mortgage, maybe there's 20 years, maybe there's 25 years, maybe you just moved into a new house and it's a 30-year, or, we got the 50-year mortgage coming. Right now, we don't have too many term policies that'll cover 50 years, but that might change. Who knows, right? Most veterans right now choose, anywhere from a 20, 30, 35-year term. But we also have a few carriers that we work with that will actually offer a 40-year term. And in fact, we just wrote a couple of these policies recently. 40-year term for $1 million of coverage. And it really was a lot less than you might think, right? So the key is to lock this in while you're healthy. If you want 40 years worth of coverage, you have to get in when you're young, okay? Because if you try to get a 40-year policy at age 60 or 70, the answer is going to be a resounding hell no from the insurance carrier, okay? They will not issue a term policy to somebody who's 70 years old that's going to cover them for 40 years because most of us just ain't going to live that long, okay? So it's not going to happen, right? You have to get this while you're young. Most veterans, again, choose 20, 30, maybe a 35-year, but we do have options that can go longer. Okay, so think about when your mortgage will be paid off, maybe when your youngest child would finish college, right? And that's kind of that sweet spot that we shoot for when we're trying to design these term policies. All right. Coverage amount, quick rule of thumb, we can do an income replacement. We can look at 10 to 15 times your annual gross income. We can look at debt plus expenses, so we can add up all your debts and do all that, right? But at the end of the day, it's going to be, what are you comfortable with, right? What is your family comfortable with? That's really what it boils down to, right? Your family has to be comfortable. That's the whole goal of life insurance, is to give you that peace of mind so that you know that you're protected from day one, right? So again, these are not rigid rules. They're just starting points. So your family's actual budget and your spending patterns is what's going to really dictate this stuff, right? Your long-term financial goals. And then, of course, your current insurability, right? How healthy are you? What does that premium look like? It probably doesn't make sense for somebody to be paying, $600 or $700 a month for, $50,000 or $60,000 of coverage. There are people that do. I don't know why, but that's we want to make sure that we tailor the amount of coverage to what is comfortable for your budget so that you can continue to make those premiums over the course of whatever that term is, whether it's 10 years, 20 years, 30 years, whatever. We want to make sure that it's comfortable and that you have that peace of mind so that your family is going to be protected. The big thing with term insurance is that in many cases, it's very fast and it's very simple to get, okay? There are some types of term that do require medical exams, especially depending on the amount of coverage or also depending on your existing health conditions, okay? But in many cases, for young, healthy adults, we can get these policies issued same day, oftentimes within a 15-minute phone call. Right? I have literally written term policies that from start to finish, from the hello, how's it going to, hey, congratulations, you're covered. And now, you got to watch your back at the top of steps, right? I'm just kidding. We literally, you're talking about a 15-minute phone call. In all seriousness, a 15-minute phone call, we can get these policies issued. It's very simple. Okay. Some of these require medical underwriting. We can compare the costs, right? The premium costs across the board. You might have a policy that offers you a little bit lower premium if it does go through medical underwriting, but in most cases, those are accelerated underwritings, especially if you're in good health. So whereas you might have a slightly higher premium, for a policy that we would issue within a 15 or 20-minute phone call, just simply because they're doing a very abbreviated underwriting process. If the policy, let's say it took, underwriting took, 3, 4, 5 days, maybe a week to issue, it might save you a little bit per month on your premium because they're doing a more thorough background check. Coverage is completely customizable. Okay, completely customizable. We could start with a $50,000 policy. In fact, we could actually start with a lot less than that. We have policies that can cover starting at even $10,000 or $5,000 if that's what you want. But for term, specifically, we typically start about 50,000 because it's very cheap, right? And we can go up to well over $1 million, right? We could cover you up to probably around $10 million of term coverage. And even then, if we wanted to go higher than that, we could bring in, if you have that insurability, right? If you have the insurability, you have the income to justify $20 million of coverage, I promise you we can get it for you. Okay. And then the main thing too is that we can adjust this as life changes, right? So as things happen, right? Maybe you get married, you have a new baby, you buy a new home, you get a new promotion, right? Your coverage can grow with all of these things, right? So as your income goes up and you need additional coverage, we can simply add additional coverage. And in most cases, we can do that with the exact same simple processes that we use to get you the initial coverage in the beginning. All right, so we get the question a lot, what happens if I outlive the term, right? Which does happen in most cases, and frankly, we hope that it happens, right? I mean, if I get a 20 or a 30-year term policy at 40 years old, I hope that I outlive that. Well, we do have options, right? And we have options that can either give you a refund, if you do outlive the policy, or that could convert the policy into permanent insurance after a certain period of time. And we also have one that's kind of in between. So let's talk about return of premium. So return of premium, these are specially designed policies. Okay, so from day one, if we're doing a return of premium, you'll want to know, or we will want to know, that that's what you want, okay? That you want a policy that will specifically refund your premium at the end of it if you outlive the term. Because these are special policies that we have to kind of, shop from separately from just a standard term. But basically how it works is, let's say you get a 20-year term policy, or a 30-year term to cover your mortgage. You outlive the terms of that, and then at the end of that 30 years, you get every single dollar of premium back. So if you were paying in, let's say $50 or $100 a month for 30 years, you are literally getting a single check, tax-free check, for the entire premium that you put into that entire policy. You also have the option to convert it, right? So with most of the carriers that we work with, they offer conversion options with their term policies. It's usually within a specific window. Okay, so it's, let's say if you have a 20-year term, it might be up to, somewhere around that 15-year mark, or if you're coming up on, let's say, age 70, a lot of times the insurance carriers will benchmark it at age 70. Okay, but you have the option to convert either the full amount or even a portion of it. So let's say you got a $500,000 term policy and you just wanted to maintain $100,000 of permanent coverage to last you for the rest of your natural life. We could just simply convert $100,000 of that. And the reason that we would convert it as opposed to just getting a new policy is because then you're already locked in terms of your health. The only thing that it's going to be a factor in terms of the coverage is just simply going to be your age. Okay. So if, let's say, you started coverage at 40 years old and then at age 60, you decided to convert $100,000 of coverage, the only factor that is going to play into what your new premium cost is going to be for that permanent coverage is just simply going to be that 20-year age difference, right? The rest of it is you're locked in. So if your health is really taking a turn for the worse, it's not going to be factored in at all. You are still guaranteed to get that coverage. All right, and then we have a hybrid strategy. Okay, this has been a popular strategy for many of our clients, where let's say they're retiring from the military and they want to secure $100,000 of permanent coverage, but they also still want $400,000 or $500,000 to cover them while they're still young and while they're replacing their SGLI. We can actually have multiple policies, okay? So we can take a very inexpensive term policy and we can marry it up to a more substantial permanent policy. I mean, it's not going to be super expensive, but it is going to be a little bit higher cost. But we put, a permanent policy that also has a tax-free cash value, by the way, so they can still use it for, the living benefits that we talk about on the channel. but we have the bulk of our coverage, coming from, let's say, a 20 or a 30-year term policy to cover their major expenses if something were to happen to them in a terrible situation. All right. And this is my recommended approach for most veteran families, to be honest, because it's going to guarantee you maximum protection, and it's also going to guarantee you forever protection. We're just not going to be paying top dollar for the forever protection. We're going to be we're still going to have a substantial amount of coverage that's going to be converted into a legacy benefit that's still going to cover your family at the end of your natural life. And then you're also going to get a much larger amount of coverage when your family is probably going to need it the most. Again, why pair a small permanent policy? Well, because then you get a lifetime legacy benefit, right? On this channel, we talk a lot about legacy benefits, right? We don't like to see, income streams from service members end when they die, okay? We don't like to see veterans benefits end when you die. Okay, we want this stuff to continue so that you basically build a legacy for your family for multiple generations, right? So your great grandkids know who you were and what you contributed and the life that you built for them. Okay, we build this stuff as a multi-generational strategy. So we use it what we call a waterfall, right? Meaning that, when you pass on your benefits, it converts into new benefits for your kids, your grandkids, and so on and so forth. With a small permanent policy, you're also going to get the cash value, right? Which is tax-free. You're going to be able to grow that tax deferred. You're going to be able to use it as a personal line of credit. Okay, it's going to be a lot cheaper to fund, your vehicles, your vacations, your weddings, etc., out of your permanent policy than it is to be going to banks and just shoveling interest out the window, to rich bankers. Okay, you want to be able to fund that stuff yourself, and that's where a permanent policy with a growing tax-free cash value is going to pay dividends in terms of giving you living benefits while you're still alive. All right. It's also going to create that guaranteed inheritance. It's also going to cover your final expenses. Okay. So we'll talk more in the future about veterans' burial benefits and, how we can really maximize this stuff there. But just know that, part of having this legacy benefit is also to cover your final expenses. So things like funerals and, any kind of end of life expenses that you might have. All right, so just at a glance, so we'll kind of take a look at, just a quick chart here, a quick rundown of the various programs that exist. Obviously, across the top of the board there, VGLI is very easy to qualify for. There's no real underwriting associated. Everybody pretty much qualifies for VGLI, okay? But the cost rises every 5 years, and the reason that it rises every 5 years is because everybody qualifies, okay? That's how they maintain that insurability, right? You can get covered up to age 60, and then it can continue for the rest of your life. SBP is an automatic program, okay, unless you opt out. We've talked at length. I'll link some videos in the comments where we talk about SBP. But if you're on YouTube, if you're watching this on YouTube, okay, definitely check out. There's a video that we'll link called the biggest retirement mistake. Okay, and in my opinion, the biggest retirement mistake that military retirees make is taking SBP. Okay, because it is not a good program. It's an outdated program in my humble opinion, and we have much better options in the private market than what SBP is going to provide you. Okay, it's not health based, so there are maybe exceptions where it might make sense, but it's going to cost you 6.5% of your pension. It's going to be cost of living adjusted. There's no cash value. The income is taxable. Okay. It'll protect your pension somewhat, but believe me, we have much better options by using stuff like this. Okay. And then of course your permanent options, permanent and term are, they are going to be health based. But they're very flexible. They have a tax-free payout, and they're best, obviously, term is best for, budget plus max coverage. So we are getting you the maximum amount of coverage Permanent is obviously going to be great for legacy planning, and it's going to be great for tax-free cash value. All right, so lowest cost right now, today, if we're talking about saving money, how veterans can save the most amount of money on life insurance, we are talking about term only, okay? So maximum protection during the years when your mortgage and kids are your biggest financial obligations, because every dollar that you put in premium just goes strictly to paying for a death benefit, okay? So there's no cash value. You still have living benefits, right? You still have your chronic, your critical illness, terminal illness riders that are automatically included. So if something, let's say, were to happen with you with a permanent, disability or a critical illness of some sort, you are still going to be getting additional benefits in the term policies. But for the most part, your premium is going entirely to your cash value, okay? My personal recommendation, of course, is option 2, right? Where we talk about blending a term policy with permanent coverage, okay? If you're on a budget, and you want to be able to just secure coverage quick, easy, and for the least cost possible, we can just strictly do term only, okay? Maybe a 30-year, maybe a 20-year, but just know this is going to be a very budget conscious or budget oriented plan. My recommendation is that we combine the two of those so that you have, maximum coverage, a big term policy. We'll say $500,000 to $750,000 for 20 to 30 years, right? That would cover your expenses and cover your income for at least 15 or 20 years if something were to happen. And then we add a small permanent policy, let's say anywhere from $50,000 to $150,000, that's basically going to last forever, right? And it's going to ensure that your family still receives a death benefit at the end of your life, even if you live to age 120, okay? And this is best for long-term planners. You want comprehensive protection and guaranteed coverage later, okay? And then, of course, we have the permanent heavy, which is basically maximum, lifetime coverage. We have folks that, just want the maximum amount of death benefit. In these cases, what we typically recommend is that we use the policy as a cash value design, right, where we would grow the death benefit over time. But, you might have a good, a good reason why you want, let's say, $1 million of coverage, right? Maybe you've got, savings, let's say in TSP, for instance, and you wanted to roll that into a permanent policy that was going to guarantee you, let's say $1 million of coverage or $500,000 of coverage for the rest of your life. And maybe you could even, you only want to fund it in one single premium payment. We've done videos on the channel before about that too. You want to make one single premium payment, never have to worry about it again, and know that you have basically a permanent protection, a permanent death benefit for the rest of your life. We can absolutely do that. But again, for most young families, option 2 really does provide the ideal balance. So let's look at a few case studies. So the first one we're looking at is let's say a Navy E6 who's 34 years old, married, 2 young kids, ages 3 and 6. They have a $385,000 mortgage with 28 years remaining on the loan. Okay, so when you combine their income, you're looking at about $95,000 a year, and their budget, as it is going to be kind of tight, but it's manageable, right? So the primary goal here is really just to protect their family no matter what. Okay, so we understand that maybe they're on a tight budget, right? They got bills to pay, they've got the mortgage to pay. They obviously just recently purchased the home or refinanced the home, so there's a lot of front load fees there. So the main thing that we want to look at here is at least covering the cost of the mortgage and then the expenses for, a certain period of time, right? So we would look at a $500,000 policy, a 30-year level term, which is going to obviously cover the mortgage balance. Plus, it's going to provide substantial income that the family can then live comfortably on if, again, something were to happen, right? And the level premiums are for 3 decades, right? So they never increase over the course of 30 years. Now, maybe we want to add on a $100,000 term, permanent policy We could have that be paid up by age 65. If we didn't want to do that in one single premium, we could also do it in monthly premiums. And we could basically have that policy completely paid up at age 65 so that by the time he hits, 65 years old, and the term is ending, or it just ended recently, he now has $100,000 of permanent coverage that's going to last him for the rest of his life. All right. So again, massive protection during the critical years when the kids are home, the mortgage is a burden, and the permanent policy ensures that something stays in place forever, even after the term expires. All right, case study 2, we got an Army captain who's 41 years old, got a spouse and one child, age 8. They have a $520,000 mortgage. They just recently moved into the house, so they got 30 years. They're starting brand new with $520,000 mortgage. Now his income about $115,000 a year. They have college savings started for their child, but they're not fully funded yet. Now, if they do that, I would recommend, if they're looking at a 529 plan, that we have better options than that. So if you're, just kind of as a side note, if you're talking about college savings for your children, we need to talk offline about a separate subject, because believe me, we got much better options than a 529 plan. Spouse works part-time, income dependent household. Obviously, they require income to be able to sustain. So the primary goal here is complete income replacement plus mortgage coverage. So we want to ensure that the family can maintain their lifestyle if, something were to happen to him. And again, he's in the Army, so he has $500,000 of SGLI. So we would want to add on, that 30-year policy, not so much because the SGLI is not going to cover his expenses, but because, one, it won't, because he's got a $520,000 mortgage, but two, because we're locking his coverage while he's still young, okay? We get service members that ask us, like, well, why would I start a life insurance policy when I've already got SGLI? Well, it's not that we think that the SGLI is not enough coverage. In many cases, it is. But what it's doing is it's locking in your insurability at a young age to make sure that when you get out of the military, whether it's 5 years from now or 20 years from now, that you're still going to be covered and that you're still going to have that coverage for as low of a cost as possible. Okay, so that's what it boils down to. It really boils down to securing the cost of the coverage at a young age while you're still healthy and while you're still insurable. Okay, and in this case, they might decide on a return of premium option, right? So they might look at, having a little bit higher monthly premium. I mean, at 41 years old, it's not going to be that much higher. I can promise you that. It's really not going to be that much higher. But if he outlives a 30-year term, every single dollar of that premium gets refunded, right? So they're going to earn back, or they're going to receive back every single dollar of that premium in a return of premium policy. And we would compare those side by side, right? So we're not just going to make one recommendation over and without presenting another, okay? So just know that you have that option. If you're young, you're healthy, and you're concerned about outliving the policy, we do have an option that would give you a full refund at the end of it, right? Okay, and then case study number 3, we've got a Marine Corps veteran who's age 52, is married, but no dependent children because they're grown, right? So by that age, the kids are already out of the house. They've got a condo, $260,000 owed on it with 20 years remaining. Combined income between, retirement and everything else, about $140,000. They've got pretty strong retirement savings already in place, but the veteran wants to make sure that he protects his spouse so that she doesn't lose the condo if, something were to happen. Obviously they don't want to overpay for coverage. Especially because the kids are grown and, they don't necessarily need all of that income to sustain their well-being, right? They just want to make sure that the house is paid for. So here we might look at, okay, well, if you have 20 years remaining on the loan, how about we just set up a 20-year policy that would cover $300,000, right? So that by the time he's 72 years old, the condo is paid off and they no longer need $300,000 of coverage. Right. And then we also have the option to convert, right? We have what's called a conversion rider or a conversion option, which is going to give him the option at any point during that 20-year term up to basically 70 years old, is going to give him the option to convert all or a portion of that to permanent coverage. So it's going to keep those current premiums low. He doesn't have to convert it if he doesn't want to, but if he stays healthy and he doesn't need the conversion, then at least he paid less overall. And if he does want to convert it later on, he at least has that option. He can convert that coverage into permanent coverage that will last him for the rest of his life. All right, so here we go. So let's talk real numbers. So what can you actually afford? Well, here's what different monthly budgets can typically buy for veterans that are in their 30s and 40s. Okay, again, this is all health dependent, right? I don't want to give quotes, that's not what we're here to do tonight, but we're just kind of giving you some ballpark figures. So in that $30 to $40 a month range, younger veterans on tighter budgets can typically secure anywhere from $250,000 to $350,000 for somewhere between 20 and 30 years. Okay, and again, we can always add more coverage as your income grows. For most families, roughly 50 to 70 a month is kind of that sweet spot. Okay, that's usually going to give you somewhere between 500 to 750,000, depending on your age, of course. And we can secure that for 30 years or even 35 or 40 in some cases. And it's going to cover your mortgage. Plus, it's going to give you some solid income replacement, if something were to happen. Okay. And then when we kind of get into the little bit more premium plans, right? The premium protection tier, somewhere between 100 to 150 a month is going to give you those higher face amounts, higher death benefit. Where we start to get into like the 1 million plus death benefit, or even the return of premium options, or when we're starting to add in that hybrid approach, and that could even get up into that $200 to $300 a month range as well. But I can assure you, though, when you do the math, right, when we actually do the math, and we will do this on a call, which again, if you guys want to book a call, I'll have the link below. My calendar link is on there. If you guys want to get a free quote, you can either just type type legacy in the comments, right? Go ahead and type legacy in the comments. I will reach out to you and I will get you a free, no obligations quote, and you can look at exactly what your numbers would be. Okay, but just know that, like I said, if we start to kind of get into that premium protection tier, that's usually going to be somewhere between $100 and $300 ish a month, depending on how much you want to get in. And again, your exact rate is going to be based on your specific age, your health, your state, your tobacco status, all the things, right? Including your VA disability compensation rating. That's another one that plays a factor, okay? So just know that those things are going to, vary person to person. But these are just kind of some ballpark figures that kind of apply across the board, especially for healthy individuals. All right, so again, quick compliance notes. The rates are going to vary. The death benefits are going to be paid income tax free under current federal law. Your beneficiaries are going to receive the full face amount. There are no IRS deductions on that, and you have total control over your beneficiaries. You can choose whichever beneficiaries you want. You can change them as often as you want. You can add as many as you want. Okay, you have total control. You do have return of premium and conversion features, okay, that we can add on. Not all policies include these, but we will show you which ones do. Okay, and make sure you read your policy documents. Okay, we always encourage clients, I kind of half jokingly say, be as difficult as possible, right? I expect questions from my clients. Read through your documents, make sure you're familiar with what you're signing, make sure you're familiar with what you're getting. And we'll make sure we walk you through everything so you understand it. All right. So common mistakes to avoid. Waiting until later, okay? I really cannot stress this enough. It doesn't matter how healthy we stay, okay? It doesn't matter that, at 50 years old, you decided to join the gym and convert, to a new high protein, whatever, healthy diet. And now all of a sudden you're in the best shape of your life. We hear those stories, and they're great stories. Don't get me wrong. They are awesome. I see a lot of content out there right now, especially on YouTube and social media about getting fit over 40, and people are in the best shape of their life when they're 50 years old, okay? But you're still 50 years old, okay? And we get older every single day, okay? Every single day, every single year, we're getting older and older and older, and we cannot stop time, okay? So waiting until later, even if you're going to be fit as a fiddle, right, at a later date and time, is still going to result in you paying higher premiums, guaranteed. Okay, that is just the nature of life insurance. It's the only way that it can work from an actuary perspective, right? It's the only way that the system works, is that the premiums have to get higher, especially with renewable term. They have to get higher as you get older, right? It gets more expensive. So every year that you wait, your premiums increase. Not only that, but health issues can appear, okay? They can appear suddenly in many cases. Some of those can make you completely uninsurable. I can tell you one in particular that I had last year. It was a very young, healthy individual who developed a very simple skin melanoma, just a very small amount that was removed, right? And was in remission, but because of the history of cancer, became completely uninsurable. There wasn't a single carrier that was going to cover her. Not a single one. And she was like not even 40 years old. Okay. So just know that your health can change drastically. And even if it doesn't change drastically, just a simple thing like that can be a trigger that could literally render you uninsurable. Okay. So every year that goes by, it could be potentially more expensive. Okay. Relying only on your job's coverage. Okay. There's a couple of problems here. For one, it usually isn't enough. Okay. Employers offer group term plans for recruitment and retention. That's the number one reason why they do it. They want their employees to get that benefit so that they stay there longer, right? And that makes sense. But most of the time, those coverage plans are very inexpensive, and they provide very little coverage, right? They might provide you with $50,000 to $100,000. Maybe it's usually just a 1-year salary in most cases. So whatever, 1 year's worth of pay is generally what the life coverage is. So if you were to get, it disappears though if you change jobs or you get laid off. Okay, so if you leave the company that you're working for that's giving you $100,000 of coverage, that just like SGLI, it's gone, right? You don't get to just take it with you, because at the end of the day, the employer owns that coverage. You don't actually own it. That's group term. Okay, and you also have zero control over it. So you want to build a plan that travels with you, not one that you got to leave behind when you potentially change jobs or whatever. All right. Underinsuring the gap. So many veterans think, well, I'll just get enough to cover the mortgage. That could work. If that's all we can afford, then great. Let's at least cover the mortgage. I would much rather have a veteran cover their mortgage with protection than not have enough. But if you do have the means, right? And again, we're talking about term coverage. We're talking about saving money on coverage. If you have the means, you should be thinking a little bit bigger than just covering just the dollar amount on the mortgage. Okay, think about income replacement. Think about what it would look like for your family today, tomorrow, if something were to happen to you and they were basically reliant on this coverage to be able to sustain for, however long it would take them to get through that grieving period and kind of get back on their feet. Are you going to put them in a position where they're worried about losing their home, where they're worried about not being able to pay the bills, where they're worried about the utilities getting shut off, the cars being repossessed, all this stuff, while they're just, it's the worst time of their life. It is the absolute worst time of their life, right? They're grieving over your loss. And now they're having to worry about all this extra stuff, and it just creates stress, right? We want to alleviate that. That's the goal, and achieving this peace of mind. Okay. The fourth one is going to be not naming contingent beneficiaries. So a lot of times, when we set these policies up, we ask, that's one of the questions we ask, do you want to name contingent beneficiaries, right? What is a contingent beneficiary? It's basically somebody that's going to receive the death benefit if something happens to your primary beneficiary. Okay, so you and your wife, you and your husband are in the car together. God forbid something happens and you get into the, whatever the accident, and then you both are gone, right? What's going to happen? Like if the husband was covered and the wife was the beneficiary, or vice versa, if you're both gone at the same time, what's going to happen then? Where is that benefit going to go to? Is it going to go to the kids? Is it going to go to, a third party custodian? Is it going to go to another family member? We want to talk about that, and we want to be able to help navigate that process, because there are special considerations if we're going to name minor children as contingent beneficiaries. So we want to also be able to talk through that kind of stuff too. All right, so beneficiaries, keep it simple, keep it updated. We update this stuff on an annual basis. We like to meet with clients on an annual basis to make sure that everything is covered, that your beneficiaries haven't changed or we don't need to update them. And of course, we can always update your coverage after any major events, right? Again, marriage, divorce, birth, adoption of children, death of a beneficiary even, right? Any significant changes in your life that might require more or less coverage, we want to meet with you on an annual basis. And if you have a policy right now, okay, I'm going to say this again, if you have a policy right now with an existing carrier, with an existing company, I want you to ask yourself, when was the last time you spoke to your agent? Okay, I'm going to say that one more time. When was the last time you spoke to your life agent if you have life coverage now? If the answer is, oh, or something to that effect, we need to talk, okay? Because you should be meeting with your life agent at least on an annual basis, okay? So make sure, if you're not meeting with your life agent on an annual basis, we need to talk, all right? And I'll just leave it at that. All right, so how we shop for you. So this is the independent agent advantage, right? I am an independent financial professional and independent life agent. So my job, I'm not a captive agent, right? So when you receive like those envelopes in the mail from USA, well, I don't want to say the name. Well, okay, USAA, right? For instance, Navy Federal, right? I don't throw the names out there. Why not? You receive those envelopes in the mail. Hey, we can get you $50,000, $100,000 of coverage, blah, blah, blah. Those are captive agencies, okay? In most cases, they're going to have very limited coverage options. Usually it's about one or two products, okay? And they're going to be most likely more expensive than what you're going to get anywhere else, okay? There's other ones out there. We can talk offline about which, agencies and firms are captive, and which ones are independent. Just know that I am an independent agent. Victory X Financial is an independent agency, okay? Meaning that we're kind of like the Amazon of the insurance world, right? We get to shop your coverage around and we will find the best fit with, top-rated carriers some have been in business, many of them for over 100 years, right? They're extremely solvent companies. And we compare all the options, right? We want to get you the best premium price for your age and health profile. Every carrier has different underwriting standards. Every carrier has different premium rates. We're going to make sure that whatever situation you're in, right, whatever profile you fit, that we offer you the best possible coverage so that you're getting the best deal. It's not one size fits all. My job is to find the best combination of coverage, price, and features to make sure your family is protected. I take that job very seriously. That is a core mission responsibility for me, and I make sure that every client that I work with, that we thoroughly vet that process. Okay. And sometimes it's a mix of carriers, right? We might have multiple carriers insuring multiple members of the family, right? Because in some cases, it might make sense to stick with one versus another, and we can always shop around, depending on what kind of policy offers we get. Again, riders that are worth considering. Accelerated death benefit. The living benefits come with most of these policies. So if you're diagnosed with a terminal illness, let's say you're given 12 to 24 months to live, you can access a pretty significant portion of your death benefit while you're still alive, okay? And that just goes to cover, a lot of your expenses, obviously, medical care, bucket list items. I can tell you that there have been clients where the living benefits have actually saved their lives because We think about TRICARE even. There's things that even TRICARE, if you have it, or VA care won't cover, right? There's experimental treatments. There are certain types of medical expenses that even those, golden ticket insurance policies won't cover. Your death benefit, if you're able to advance a large portion of it while you're alive, you can use it however you want. And in some cases, it's actually served to give people more time on Earth because they were able to fund medical interventions that wouldn't have been funded by their existing health insurance. Okay. We do have waiver of premium options that basically would kick in if you get totally disabled and you can't work, so that way you're not having to pay premiums while you're out of work. We also have child riders. So if you wanted to add on, let's say $10,000 or $20,000 of coverage or $25,000 of coverage for your children up to the age of, let's say, 25, those are normally very cheap riders that we can add on to the policy that would give you additional coverage for your kids. Okay, and again, that comes at a very, very low cost. All right, so really, like I said, when it comes down to the action plan, we're keeping it simple. You pick your term length, so you decide how long you want coverage for, whether that's 20, 30, 40 years, even 10 years, whatever makes the most sense. We help you determine your coverage amount, whether we're using the income rule or the mortgage benchmark or the debts, plus 5 years of expenses. We can calculate that however you want. We choose our add-ons. We complete the application. In many cases, we can get this issued literally same day, oftentimes in the same phone call. And then we just go into an annual maintenance mode, right? So we meet on an annual basis at a minimum. And then periodically, as life changes, we can make updates to these policies. It's an ongoing relationship with our clients, right? This is not just a one and done. We don't just like, hey, here's your insurance policy, see you later, have a great life. No. This is an ongoing relationship that we plan to have for many years, and that we're annually reviewing this to make sure that you're covered, that your family's covered, and that, anybody that's close to you, that may need coverage, we can cover them as well. We can, adjust for any type of life situations that occur during that time. Okay, so an ongoing relationship. And again, most veteran families complete everything needed within that first week from the first conversation that we have to placing the coverage in force. So it's a very simple process. All right, so when we do the quote, right, we do basic information pre-screen. So we'll get, some health information from you. And of course, whether you use tobacco, it only takes a few minutes. But it allows us to pull in all the accurate rate classes so that when we're talking numbers, right, we're actually paring it down. We're talking like real numbers. We're not just like making stuff up or, pulling stuff out of where, okay? We want to then, run the numbers based on various term lengths. We can compare different term lengths, so we can look at, 25 years versus 30 versus 26, 27. We have those options, okay? We can totally customize that to whatever your needs are. We can give you some instant ballpark quotes, based on what we think, based on the input that we got. Obviously, the more detailed, the better. And then we can just lock in the best fit. Okay, so it's a very smooth, very streamlined process. I can show you quotes from typically the top 2 to 3 would be sufficient. Those top 2 to 3 are usually going to be the most competitive. They're usually within less than $1 of each other per month. But we give you a side-by-side comparison. We can kind of break down the pros and cons of the different carriers. And we do this, with no high pressure, right? This is not a sales tactic. This is not a funnel, right? Or whatever you want to call it. We're not collecting any sensitive information here. We're not putting on some kind of a high pressure, environment that's going to force you to get something that you're not comfortable with. All we're doing is we're just providing you with transparent pricing and clear options, right? Because we're all about education, right? We are all about education on this channel. We are all about just informing veterans of what their options are so that they can protect their families in a way that's the most comfortable. Okay. All right. So again, if you guys have any questions, go ahead and drop them in the chat. I know we're kind of coming up toward the end of the hour here. So this is your time. Go ahead and drop those questions in the chat. I will get to those as soon as I see them. We can talk about VGLI comparisons. We can, if you guys want to know what the VGLI would look like at a certain age or what you would pay in over time, we can talk about that. We can talk about coverage gaps. If you guys got questions about, hey, how much coverage do you think I need? What about specific health conditions? How things like divorce can affect your beneficiaries? What about deployments, right? This is one thing we specialize in, right? We specialize in dealing with the military and the veteran specific issues. What about things like PTSD, right? How do those things affect your health benefits or your health risk rating? So no questions too basic. Just go ahead and drop those comments in there. And again, if you drop in the word legacy, we said legacy, right? Yeah, legacy. I'll go ahead and get in touch, and we can talk about getting a free quote, or just go ahead and book a calendar appointment, a free phone call. I'll put my Calendly link. It's calendly.com/victory-x financial. If you guys just use that link, you can book a free 30-minute discovery call. Absolutely no obligations. You can hit me with whatever questions you want. And even if we don't end up doing business, at least you'll have the information, and you can take that information and run with it, right? You can shop that around if you want. I can promise you, though, you're going to be in good hands. So most of our clients that shop it around, they end up coming back later and they say, yeah, you know what? You're right, Dan. You did have the best options. You're welcome. There you go. All right. And then lastly, if you guys have a policy existing, if you have an existing policy, we offer free policy reviews to any clients and even non-clients or future clients, as we like to say. So if you already have coverage, we're happy to review your coverage. We can run quotes to see if we can get you better rates. In most cases, we can, right? We'll tell you if we can't. I mean, if I can, I can't. There's nothing I can do about that. I don't own the insurance companies. I'm just a representative. But if I can, which I generally can, then we can get you better quotes. Or we can even increase your coverage in many cases. So if you have an existing policy, let me know. Again, just type legacy down in the comments, and we can get in touch and we can talk about your coverage options. We can also talk about any coverage gaps you might have. We can, shop it around. We can look at conversion options if you wanted to convert your insurance into permanent. If your current coverage is great, I'll let you know. But we've got a lot of options. I can promise you that. All right, so quick recap. We covered a lot tonight. We looked at term life. It's pure affordable protection, maximum death benefit, minimum premium, right? This is how veterans save the most on life insurance. Talked about mortgage protection, all right? The 3 strategic ways: full value of the house, remaining mortgage balance, critical period, maybe a year or 2 of mortgage payments. Talked about the SGLI gap. It is real, okay? When you get out of the military, that SGLI goes away. So you want to solve that as soon as you possibly can, even while you're still in. So if you're still in the military and the only coverage that you have right now is SGLI, we need to talk, okay? So book that link, right? Book your free call. I can promise you will not regret it, right? There are no obligations with this, and we can talk. All right, smart options if you outlive the term, right? We talked about return of premium. We talked about conversion. We talked about the hybrid strategy. Again, that's my number one recommended for most veteran families, is the hybrid strategy, where you're going to get that maximum coverage when you need it the most, plus you're going to get that legacy benefit that's going to last you for the rest of your life. And typically the policy that's going to be, that term is going to be somewhere between 20 and 30 years for peak obligations, right? So you get comprehensive protection now, guaranteed coverage forever. All right. So again, simple 3 ways to get started. If you want to drop legacy or coverage, right? Drop coverage or legacy, or just shoot me a DM, right? One of the 3, right? Coverage, legacy, DM me. And we will get started on this. It's a very simple process. You can book a free 30-minute call. Again, you'll get a free quote out of it. You'll have a pretty good understanding of this stuff and where you stand, and where you stand to save, most importantly. And we can always do a policy review. So again, I offer free policy reviews, no obligations. we can let you know where your policy is in comparison to other options out there. So no pressure, no obligations. We're just here to help. All right. So that's it. Here's my contact information. Again, I'm Dan Farnsworth, retired Navy officer, founder of Victory X Financial. You guys can email me at daniel@victoryxfinancial.com or visit victoryxfinancial.com, or like I said, just simply drop coverage or drop legacy in the comments, and we will get to every single question, every single comment, and I will reach out. Again, this is a zero cost, right? Zero cost, free, no obligations quote to show veterans how they can save money on life coverage, and most of them are shocked to learn how much they can save. All right, so that's about all we got. So to every veteran, service member, military family, your service to this country matters, right? Your sacrifice matters. So your family's financial security matters just as much, right? So we want to make sure that your family's protected because you protected this nation, right? You gave, basically a blank check to America. So now we want to make sure that we return that same, sense of giving back to your family, that same sense of protection, of security back to your family, right? And we will finish with a quote there from Jeff Miller: "The willingness of America's veterans to sacrifice for our country has earned them our lasting gratitude." So I am personally grateful for everything that you guys do for this great nation. Again, I'm Dan Farnsworth. If you guys have any questions, I will stick around in the comments section afterwards. But that's all we got for this week. We'll be back next week with another episode of Military Money Mondays with Dan Farnsworth, Victory X Financial. See you guys.